going again. Well, listen, this is where we're going to want to have a look at what's going on. Quickly here, let's see what happened with these jobs numbers. So first off, I want to highlight here that surprisingly it was an outlier move, and that was really what was needed in order for those jobs numbers to change the path from which stir traders would be anticipating or forecasting which direction to take the future Fed path. And right now, with the jobs numbers more or less coming in line, we'll see in a moment that they didn't really create a big reaction on the rates markets, and that maybe at this point we're gonna have to wait until the next Fed meeting for the rates markets to wake up. So it came in at 50,000. Forecast was around 66,000 or 70,000. So it came in a little bit weaker. But what was interesting was that we saw decline back to 4.4% on the unemployment rate, which is kind of bizarre that the unemployment's going down, yet at the same time non-farm coming in weak. Irrespective, it's more about market reactions than anything else. And the S&P's flat, but it wasn't the S&P where we thought the reactions were going to be. So as far as I was concerned, the first reactions should have been in the dollar and in the rates markets. But let's start off with the rates markets and see what's happened. So first off, this is the December 2026 SOFR futures. Basically, what they're anticipating rates for the remainder of the year. It initially ticked down on the news, but has more or less recovered, being relatively flat on the day. So we don't have a big reaction here yet, but we are still more or less, at least from a trading perspective, where we've been all month. And so no big move here. And I don't really want to talk more about it because this is not where the action is. More importantly, there was almost little to no immediate reaction on the bonds themselves. This is the long bond, the 30-year. And what you can observe is that it's been stuck in the mud, trading sideways. And you can see that today's jobs numbers did nothing to really get it trading out of this trade range. A little bit of weakness, but it could easily be a green day tomorrow. There's just not enough technical evidence. Overall, the rates markets have been sideways to downwards trending. Bond markets have been sideways to downwards trending. Rates have been upwards to sideways trading. And but I don't think there's more to talk about here yet. Even the junk bond markets, like high yield credit, relatively quiet, improving a little bit. There is no signals coming from the rate markets that are influenced in the broader markets. The second place we thought there was going to be a big reaction potential if there was an outlier number was the dollar. And the dollar today upticking up 26 cents on the dollar index. This is yesterday and today are the first closes back above the 50-day moving average since it broke down in November. This is important because the dollar, it's pretty consensus bearish. It's clear that the administration wants a weak dollar, stimulate the middle class. Will they keep the dollar weak into the midterms, as a lot of people talk about? I don't necessarily have a high conviction on that view, but this is definitely a view that a lot of people have out there. Now, what is a little bit surprising to me, well, first of all, we had a clear double bottom come in on the dollar that formed throughout the summer. And right now we formed what is known as a right shoulder. Now, at least we speculate whether, or stress test whether this is a right shoulder or not. This is for us to find out. Now, if it is, and it becomes a cup and handle formation, this break above the 50-day moving average could usher in an up move in the dollar. First of all, what would that mean? Well, this is important because one of our big theses that if the US dollar remains in a bear market and weak, the reflation trade remains the dominant one. And it's a huge bullish tailwind for commodities. All sorts of different sectors benefit, emerging markets, global equity, all sorts of things do very well in that environment. And alternatively, a US dollar rising could start to spur and be a lead into a risk off cycle in the markets. We were not necessarily bullish the dollar here, but we can't ignore the dollar rising because it's always those things that the market is not expecting to happen. When they happen, create the kind of ripple effects that create huge market shocks. Now, without me forecasting the dollars going higher, what are the levels to watch that are where you need to know something different is happening than that bear narrative? And to me, that's all about this fib zone. You can observe here this 99 to 99 and a half also lines up with the high from October, and this is a resistance level. So if the dollar fails here, gets back below the 50-day, then the prevailing downtrend is the dominant one, and everything stays in that bear thesis. But if we suddenly are ripping up to 100 on the upside of the dollar index, something bullish is underway, and this could really catch a lot of traders off guard if it happened. Now, I'm not forecasting that the dollar is about to rip, but I'm not going to be ignoring it because there's a huge amount of intermarket kind of implications that could really get things going if this surprises the marketplace on that move. Watch this one closely. Now, just briefly, let's talk about the S&P 500 and just the impact overall on the cash index. There are a number of measured moves that clear 7,000 or round numbers like 6,000, 7,000 are always magnets to markets, and the fact that we are 50 points away from 7,000, I don't see how the market doesn't finish a quick impulse move that gets up to 7,000 to 7,100 up into this target zone. This is a gimme. Now, we have some very important news. I should have even announced it at the beginning, but we're about to hear from the Supreme Court at 10 o'clock, just less than 30 minutes from now, out at Washington time at 10 o'clock. The Supreme Court will take the bench to make a ruling as to on Trump's global tariffs. And few of the justices are skeptical and about these emergency powers laws, and we may see a rollback, a full or a partial rollback of tariffs if a Supreme Court rules against it. That may make a market reaction, and the stock market may actually pop on that news if that became the outcome. Now, I don't think that would be a huge new bull thing because Trump will quickly come back and pursue other tariff tools to try to achieve his goals. And so it'd be one of those things where it's probably just a short-term reaction. But we can't ignore it because it's literally can happen here in 30 minutes. And maybe that will be the catalyst that maybe gets the S&P up to that 7,000 level. What is it that we want to know, though? Well, there are a number of different ways that this market can go up to 7,100, even 7,400. And while we were concerned about a market correction back in October, November, that one happened. Now, we are in a really interesting moment where the bull trend is intact. It's working in their favor, and there has at least been no catalyst introduced to spur the animal spirits of fear and cause panic selling or start to turn the market bearish yet. So we're not being alarmist in any way on that. But buying downside insurance on the S&P 500 is actually super cheap right now, and the markets are holding at their highs. And so with volatility during this holiday period having gotten down to levels that were lower than any point in 2025 is just showing you the volatility premium on portfolio hedges are actually crazy cheap right now. And so, it's one of those scenarios. Do you buy cheap insurance? It's like the analogy I would offer you is this: like if you own a beachfront property and you're buying hurricane insurance during normal conditions, it often can be reasonably priced. But if you turn around and try to buy that hurricane insurance after a storm is forming out there, they may double or triple the premiums on you with the fact that a storm is potentially imminent, or may not sell it to you at all. In the same way, do you buy portfolio insurance when it's super cheap because no one's worried about anything? Or do you wait to buy the portfolio insurance when suddenly something is stirring and then suddenly vol premiums jump to actually command a larger premium. That's definitely a puzzle to solve. I believe that it could be a balance where you start poking your finger, poking your portfolio with a couple of hedges in there when they're cheap, but you don't do structurally large hedging. You sort of layer it in, leg in a little bit at a time, and then maybe put a little bit in here when it's just on the basis that it's super cheap in a very calm period of time. Anyway, there's lots going on. We've been talking with members about gold and silver. So far, gold and silver, all dips are being bought right in the fib zones. The trends are in place. We're right now still long positioned. Obviously, implied volatilities in gold and silver are very, very expensive right now. At least silver is. Gold, not so much. The one thing to watch on silver is going to be when the Bloomberg Commodity Index does a big rebalancing here in the next week, and silver, because of its weighting, jumped up. Will we see some selling pressure on silver just based on flows from index rebalancing? Is going to be just a silver story, and it shouldn't really impact gold on that. The last thing I want to leave you with is oil. And I've said it in a previous video earlier this week, and I'll say it again. When the market brushes off bad news and recovers quickly, it means that it's found a fair value zone. That's not immediately bullish, but it does mean that you have a layer of support developing underneath this market. Look at this. We're attempting to close above the 50-day moving average on crude oil for the first time since a little attempt in September. And that's coming after a wave of bearish news. Don't ignore this. Something I'm going to be watching with my members. Listen, I'm going to just wrap up with this, and I'm going to say, 2025 was a great year. Lots of awesome returns came in there, and 2026 is going to have a whole bunch of surprises and a lot of opportunities. And I'm so stoked and excited about not only taking our YouTube listeners, but my members at Big Picture Trading through all of this. If all of you want to go through a more curated path with more access to me directly, make sure you check out a free trial to Big Picture Trading in the links below. But otherwise, wishing all of you a happy new year, and let's make this a successful year, everyone. Cheers.